So thank you very much for attending the webinar session. For those of you that don't know me, my name is Craig O'Sullivan and I'm a Senior Wealth Manager for Holborn Assets. Holborn is one of the largest financial advisory firms in the Middle East. We've got 400 plus advisors working globally. As a group, we've got 2 billion assets under management. So in regards to what we do, it is anything in regards to financial planning, protection. Personally, I look after clients with all aspects of financial planning through pension transfers, international local mortgages, property investments, and investment platforms. Personally, I've been working in the financial services sector for the past 8 years and currently living in Abu Dhabi, which is slowly starting to open up. Obviously, over the past 2 years, it's been hit quite heavily over the pandemic. So it's good to see that Abu Dhabi is starting to get back up to sort of similar Dubai standards. Good to see. Joining with me today is Jeremy Marshall. Jeremy Marshall is someone that I've been working with for the past 8 years, personally in regards to my own property investments as well as my clients. Together, we've managed to build property portfolios for my existing clients over the years, and we typically concentrate on the UK market as well as the European market. The general idea about today's webinar session is to give you more of an idea about the reason why people have been looking to invest into the UK over the past 2 years, especially why it's so popular, and pretty much what we feel would be sort of good areas to look into over the next 5 years for an investment opportunity. So if there's any questions that you've got, please use the box below in this webinar session, but we can open up the Zoom meeting at the end of this call and have a bit of Q&A. So if there's any questions that you've got, please put it into the box, or at the end of the webinar session, we can go through them and answer them as best as we can. So I'll pass over to you for now, Jeremy.
Thanks, Craig. Hi, everyone. Thanks for joining us on your evening. As I said, Craig said, I think today's event is, it's a bit of an insight. There's going to be no kind of product pushing. We're not going to be kind of saying, hey, this is a building, this is a building. You know, of course, we've got lots of them there, and we can talk about that offline individually. But this is, at its core, like the most helpful we can be about how to invest, why anyone would, what things to look for and look out for. And to have a kind of a macro sense of how to make good investments within the UK specifically at the moment. There's been an awful lot going on there over the last few years, and it's very hot right now. But equally sometimes that comes with some risks. So we're going to look a little bit about that, and where's a sensible idea to put your money in the long term. So I'll start with a little bit of introduction of IP Global, and then we'll look into essentially it's a how, why, and what of property there. And by all means, if any particular points or slides are making interest, feel free to put your questions in the Q&A box, and Craig can look at those throughout. You don't have to wait till the end, and then we can kind of cover everything when we get to the end there. So some things will be very specific, others kind of useful for everyone. So it's important then to understand a little bit about us, IP Global as a company, in relation to Craig and Holborn and the investment world there. IP Global been running for 15 years. We are an investment company. We're not an agency who sells property. We are a research-led investment company who take financial positions on properties and buildings around the world. So our investment team will go out, they will find pockets of value in kind of safe growing markets, and we will do all the research as any buyer would themselves when buying, and legal due diligence and planning and all those things. And then we will essentially buy in bulk with developers. It allows us to get in early, allows us to pick things and get wholesale discount basically on whole buildings. But it allows us then to bring good property to all our clients all over the world, and be able to then handhold them to buy an individual physical property, normally a 1, 2, 3 bed apartment, and then be able to transact and sort everything throughout that process and the whole journey. So The most important thing, obviously, is our research and our advice and getting that property to you in market and picking the right thing at a good price. But yes, we can provide all the lawyers to transact it. We've got the mortgage broker who work with banks based in the country you're buying into, and then we've got letting agencies who can be the ones to find the tenants for you, manage the properties for however many years you want to own it for, and then we can help you sell it as well. So it can be as hands-off and unemotional as it's possible to be with making an investment in property. And we're there for the entirety of it to kind of advise and tell you when to do things and when to sell or when to kind of hold on and all that kind of thing. So very much a long-term relationship kind of company. And this is why the financial services community, like your Holborn and so forth, like to work with IP Global, because we effectively have skin in the game. Every project we bring to the market is something we've financially taken a position on ourselves and onboard risk as a company ourselves. So it means that we believe in that much every project we have, and hopefully for all our clients and buyers, it kind of gives them a bit of comfort and knows that they're de-risked somewhat. So we are very global. These are kind of our offices around the world and where we've got presence. But equally, where we've been buying and selling property for the last 15 years. UK has probably been our biggest market, but we've bought and sold, I think the next slide is actually just over $3 billion in probably closing on 6,000 units now, actually. But that's over 30 cities in those 80 countries. So we're vastly experienced. We've seen every kind of developer, every kind of problem you can get with property. And, we're able to kind of handhold and deal with these things and get people through good and bad markets as investments can be. So the UK, how has it been performing? What does it look like at the moment? I expect if you're here today, you've probably been reading the press or have an understanding largely of what's going on. But it's not just this last year. The headline obviously is that prices have grown year on year 8.2%, which is great, one of the biggest rises we've seen for a long time. But you've got to put it into context in the recent history and long-term history as well. UK has always been, for many, many years, probably the UK, the world's premier international property market for people to buy into, because it's very long-term, it's very safe, they've got a very tight legal system, and it's very predictable, and that's why people like it. But it has had, the last 5 years, a very tumultuous time, a lot of uncertainty, which is always the killer for investments or property. So Brexit has been impacting that. A lot of people were holding their hand and waiting to see what happens. And then, of course, we had COVID at the end of it. So we've had a bit of a double whammy of potential, things happening here really to kind of hold the market a little bit and then also propel it at the same time. So there was a lot of people waiting to buy around the Brexit time. Then when the agreement was reached and then we got a majority government, there was a lot more confidence returned to market. And so we started to see a big boom and people started to buy again. And obviously then COVID hit and people with big question marks about what's going to happen now. And all the major consultancies in the first couple of months said, well, maybe, the property market might drop anywhere between 7 and 10%. We don't know. It didn't, obviously. The government put enormous stimulus packages in place pretty early in the system, and furlough schemes meant that people weren't unemployed. So confidence, importantly, wasn't hit in the same way, and so people were happy to keep buying. There was a stamp duty incentive put in place, and so very liquid, very cheap mortgages compared to long-term averages, and so everything's been working very well in the last little, well, at least year and a half, I suppose, in that period of time. But it doesn't mean that it's a one-off event. It just means there was probably a lot of people who had been held off for a few years have been ready to go. So there's investors and there's home movers, and that's kind of given a big, nice bump to the market. But thankfully, the core of it means there isn't the same kind of latent issues there was back in, say, 2007 with the credit crunch, when the banks went bust and the American housing market kind of domino affected the rest of the world. Here is more of it's a health crisis with COVID in the last 2 years, but not a credit crisis. The banks haven't lost their money, which has meant that that's been the property market can keep going. Lending is still available there, and it's a highly competitive market. So it's a completely different situation to a previous recession, and so it hasn't happened. So people have been out and then buying, and confidence is high, and so there's been a lot of energy in market. So The things which compound this and keep this very predictable for future about what's going to happen is, we've got the low interest rates. Yes, they will invariably rise because you can't really get lower than where they are at the moment, but slowly. I don't think anyone thinks there's going to be a big, increase very, very soon. The recent increase up to 0.25% again is pretty much historically in lows, but it's the chronic undersupply of housing. The UK, depending on which board you listen to, is anywhere between about 300 and 350,000 homes per year. In need, and the most they've built in the last 15 to 20 years is about 147,000 in any one year. So this problem is continually compounded in one of the safest, kind of most secure markets globally you can find, and so that in itself is a very attractive thing for a property market. But with the interest rates where they are, the way the currency the way it is, it's just it's a narrow timeline where this doesn't normally come together. So it points towards a healthy market going forward. Inflation, obviously, which is not good for lots of things, but that is usually a very good promoter of property. Property tends to be a bit of a hedge for inflation. So a lot of big investors start to kind of sway some of their portfolios more leaning towards property in these times. So you'll get more buyers there, which is increasingly putting up pressure on rents and prices there. So the market's risen 8.2%. What should we do then? Should we kind of jump in? Should we be cautious? And look, I think it's just a case of safety first. Don't react to the market and heavily and chase an opportunity or chase a discount or chase everyone else, what everyone else is doing. It's about the movement of people. You are following safe long-term trends, and you're going to follow the same principles which we do with every property. And I'll go into those in one of the slides in a few slides time, so you can kind of do that yourself. Whether you work with us or do it yourself, these are all the kind of things you should do to pick a good, safe investment. So, with the COVID times, discounts didn't materialize. There wasn't distressed deals around the place. It's just keep your head and do the right thing and get the right property for the right reasons, and that's following people. So I put these down here at the bottom of the slide here about questions people have very much in relation to what's going on at the moment in COVID. People are talking about, is there a cultural shift? Are people going to go and live out in the countryside, because they're going to do remote working? I think over the long term, there's going to be a slightly more cultural shift to that way. But, that's going to take a long, long time. It takes a long time to change an ocean liner, and cities are very, very important. And we've seen, the trend has been cities have been growing bigger. And any time of uncertainty for jobs at any time at all, people tend to congregate much more into the centre where the jobs are. And big industry certainly needs hotspots and centres, basically, where they can kind of concentrate and find good talent as well. That some industries will be able to be a bit more remote, but generally, cities are certainly here to stay. The look of them might change slightly. Will offices need to be as big? Possibly not. Will the high street still survive in the way it is? Possibly not. So you might get more people, properties being reconverted into residential in the high streets, which are, going to be primed places to potentially for people to live. So that kind of thing might change. But at the core of it, centres of cities is absolutely where the future still is. With a kind of gentle migration, probably for the kind of upper middle classes who can afford to upscale and upsize to drift out, potentially. So some stats is what we're going to look at for the next couple of slides, which if you're investing is the absolute lifeblood and what we should get excited about. And this is some of these are from Oxford Economics, some are from the Office of National Statistics, but it's a little bit of a look at how the UK compares and what it's going to happen basically in the next 15 years in terms of economy, and which essentially means safety for your market. Here we've got the economic growth from 2020 up to 2025, and it's looking basically to say that the red line there is from the marker pre-COVID, the GDP level there. So what we're seeing is the UK by the end of 2021 is recovering, and by the end of 22 is pushing forward and accelerating more. So actually the speed of recovery and where the eventual 5-year plan is for the United Kingdom is very competitive. It's looking healthy, and it's going to be stretching above most others in market in Europe, that is. GDP value and growth from 2020 to 2035. The blue lines, we can see what's happened up from 2000 till now. And then the grey lines in future are going to be basically what's happening up to 2035. So we can see compared to Germany, which is the largest economy in Europe, it's the next 15 years which is the most exciting. So the UK is projected to have 81% GDP growth in that period of time, which is a slight bounce back from, Brexit times and, foreign direct investment being held off. But it means there's a lot of energy, a lot of money coming into market and outperforming all its major competitors there, potentially apart from Ireland, which is also looks like it's going to have a good next 15 years as well. But again, that's for slightly different reasons in a smaller market. But what we like to see here is UK is having some of the biggest in all of Europe. Here, foreign direct investment. A healthy market means people are investing in you. This is the last 4 years coming up, and actually, usually what you'd see is Germany and UK being relatively neck and neck, and UK dropping back is because of Brexit. There's been more money kind of goes to the second, the other big economy in the region, and particularly in tech and particularly in Berlin. There's been a lot of money going in there. A little bit of risk mitigation, probably with what ifs, with what happened with Brexit. But what the general expectation is now for the next 5 years is those two front runners will be much more equal, and usually probably would expect the United Kingdom to come out on the top of it in terms of direct investment. Unemployment rates, obviously that's relevant very much for the the property markets. We want people to be housed and be employed, and there be people have cash. So we can see here at the bottom that Germany and UK are predicted to be up to 2030 the lowest unemployment rates around Europe, just being very steady. It's, of course, there was a big spike for all markets in across COVID, but generally, people, some, not all, but most markets have it relatively under control, and the outlooks are looking very good, and the long-term averages are very much in favour. So why property now? A little bit of macro, why would we do this compared to others, and why are people buying in for property? I tend to think this actually, people talk about properties being illiquid and being like the issue with it, but actually that in itself is probably its biggest strength in terms of safety. It's not transactable very quickly, which is why people put property there, money in property, because it's solid and it's not going to kind of be able to be sold in a very quick period of time. So yes, it's a slightly higher deposit. It's a lump sum investment, and it's something you have to hold in for the long term to see the decent return from it. But it does mean it comes with that less risk. You do get passive income through rent and the potential for capital growth. You have control. It's an asset you can decide when to liquidate, when to do it with, even if it takes 3 months or so. But you also get to leverage, and that's massive. So you get to use someone else's money to put, to buy into this. Which is on global terms. If you're buying UK property, that is a AA, AAA rated, safety margin of investment class. So being able to use someone else's money is very important. And so here I've illustrated this in numbers. Basically, there's no right or wrong answer as to whether you should buy in cash or should take a mortgage and leverage. But the key point really is, if you want to speed up your growth of your funds, your retirement planning, and make money quicker, using the bank's money and using them as a business partner basically into this investment in business, you will make money far quicker. And so this example here is showing this was a 1-bed, I think, we had in Leeds in the last few months, showing how much money you need if you're going to take a 70% mortgage versus buying in cash, with all the acquisition costs included, what the rental income will be, and so your net position, showing that effectively if you then buy and hold for 10 years and you see the same capital growth and same rental income as you would do in either scenario, the cash purchase makes you 80% return, and the leverage purchase at 70% mortgage would make you 152%. And that's with a very kind of modest capital appreciation, a kind of assumption of 38%. Most markets we're looking at are above that. So and this is essentially how you can then make property work for you in a safe market. leveraging is good in safe markets which grow. So what's my investor profile? This is kind of more returning it back on you. So if you're thinking about buying, if you're thinking about, what should I do next? I think it's a useful exercise to kind of do this and think about how do I relate to the property market and what kind of things should I consider? So very simple questions. What's my risk appetite? It doesn't mean, do I really like high risk things or really like low risk things, but it's just being slightly aware of risk within property. And the quickest thing to say is rental yield reflects risk. So if you see a high rental yield, yes, of course, that's quite attractive, but normally there's reasons for that. So it might be a very cheap area, which might mean it's unappealing, or no one wants to buy it for some reasons, or it's hard to find tenants there. So you don't want to be just chasing high yields. You want to be trying to look for something secure and safe, and essentially something which is always going to have a tenant in it. And there'll be certain reasons for that, like access and jobs and all those kind of things. But risk isn't about just finding something which looks like a good little bargain and it's cheap. It's about getting something in the middle, not too expensive and too low yield, but not too cheap and too high yield. So what your timeline is, that's not really, that's more in my mind about if you're like, I want to buy and get out within 4 years, property is probably not for you. Not really. It's not many markets. Yes, of course, in retrospect, it's easy to see that some people have done well, but that's not how you should plan it. You should be thinking, 7 years, 10 years ideally, and yes, a lot of clients have made a lot more money in shorter periods of time than that, but that's the kind of starting point we should go, yeah, I want to commit to 7 to 10 years, because that's how long a market tends to take its time to move, and grow, and be sensible. So that's an ideal. What your age is applicable, because that's going to be relevant to whether you can or should take a mortgage. The closer you are to retirement time, the less banks are going to be wanting to work with you. So it might be you're looking more for a cash purchase, which might be higher yield at that point to give you income in retirement. So if you've got time on your side and you're younger, then leverage it up and hold and buy and let the market do its thing. What your budget is, and again, that was kind of leaning towards don't chase what you think is cheap necessarily. We deal across Europe, and I hear people talk about Greece all the time, saying, yeah, but it's 30% discounted on where it was, and but that's because of reasons. Think about, you can afford, equally, if you can afford London prices, doesn't mean you have to go and spend that much money. It could be that the best investment for you was something in Sheffield or something in Birmingham, or which is probably got a little bit of better return potential in a 5-10 year time frame. And equally, if you have that budget, you should probably think about diversifying across countries or cities and spreading your risk in different ways. And so that last one, then, what your currency is, it's just it's just useful. Most people in the Middle East will be pegged to the dollar, which puts us in a powerful position because the pound has been quite cheap, and so is the euro. But if it's not, if you're buying in another currency, be very aware of that, just in case, the long-term implications might mean that you lose money on the currency. So, obvious common sense things, but you have to go through these to consider this before you pull the trigger on anything.
Just on that as well, Jeremy, it's very similar to me in terms of doing what's called a fact find. As being a financial advisor, it's just making sure that we understand exactly what you're looking for, your time horizons, the reason why you want to get an investment property, and know your intentions with it as well, because essentially what we can do is we can tailor and bespoke a recommendation for you if we know that information. So it's not a case that, okay, we've got one product and one option that fits all. It's really just a case of understanding your specific requirements and then tailoring around you, and that's pretty much what we've done, certainly over the past 2 years with clients that we've taken on board, purchasing in the UK and Europe. So it's I think tailoring a solution for you and your requirements is definitely something we can factor in, and just having those questions there, just knowing exactly what you're looking for can help.
Yeah, absolutely. That is right. We as buyers, obviously, we consider everything we bring to market very good, but it's not like a supermarket, and it's objectively good for everyone. Properties, some properties are more 5-year, more 10-year markets. Some are close to completion, some are off plan, you know, like all these things can be very particular about someone's situation, and maybe tax, you know, as well, that can come into it. So yeah. So how to pick a property. This is a very broad overview of essentially what our investment team will do with everything, whether it's in Japan or Melbourne or, you know, America or, you know, Germany or UK, wherever we've bought in the past. Like, we always follow the same principles, and this is what you should look at if you're wherever you're buying, really. So housing supply and demand imbalance is the core thing. That's the skeleton, the backbone of everything we're building off from here. You need not enough property for a growing population, and that growing population has money and jobs. You know, that's everything. Supply and demand is the most important thing there, because that's what puts pressure on rents and pressure on prices to go. And if you don't have that, then all the best will in the world and the best environment, it's not got reasons why it should move. So that's really important. Population demographics, you want a nice wide range of jobs and people in there, hopefully a lot of different industries within the economy as well. But again, yeah, that population to have cash effectively. The economic outlook, obviously some of the things we've talked about before, but yeah, general GDP growth, and then regeneration infrastructure. You want to see public and private money coming into market, you know, and being spent there. And, you know, you want to see that you buy somewhere in 10, 15 years, it's going to be, you know, it's going to have a facelift. It's going to be different. You know, it fundamentally, it's going to have a better infrastructure there. You know, an infrastructure particularly about connectivity and transport. If we can find properties which are near or connected to new rail lines, new tram extensions, new roads, even, you know, or new airports even opening up, that's always proven to be a huge booster of the local economy there. And, you know, more people, are, you know, a richer demographic might go and live in that area. So if we can marry all those things together, we're on a very good starting point on a macro level. And then the micro is going specifically then into the cities and into the area and the streets and the developer. And who you're buying from as a developer is hugely important. You know, there's lots of developers out there. Not all of them are huge experience, not all of them with a lot of money. So you've got to be very aware of, they've got track record, they've delivered before, and they've got the funds to get the building built, you know, a lot of the time. And this is all what we do basically when we're dealing with developers, to make sure. Little things like
that's the biggest thing, you know, because the amount of people I've come across that say to me, look, I just haven't got around to doing the research. I've held off purchasing in the UK, making an investment purchase and property, because the amount of research that I would need to do. So you have got the choice. You can take on the research and the due diligence and finding your own investment purchase in the UK yourself, or you can leave it to people that do it on a day-to-day basis. And, you know, that's one of the reasons why I like working with IP Global, because they do a hell of a lot of deep research. So we don't have to, as investors, we can just rely on them and the research that they put in to make sure that we get the yields from rental, and also, most importantly, the capital appreciation from the property itself.
Yeah. And it's not always, you know, I'd say, you know, as much as it be, you know, I would say you're in safe hands if you just trust us in everything we say. The nice thing about property is it's hugely transparent. So, you know, like the kind of statistics we have, it's kind of searchable online. You know, property values, property rents and stuff, you don't have to take our word for it. It's there online to be able to see that's yeah, the price is fair, the rental income's expected, and then you can see from all the investment and things coming in why it's likely that a market's going to be different in 5-10 years time. So, you know, we're effectively very good at collating all the information that's out there and presenting it in a nice package. I suppose that's the thing. So but yeah, price comparables, you know, in terms of micro research, if you're going to pick yourself, it's not always about headline values. You've got to be very aware of price per square foot. It's all very well going, well, that looks like a cheap apartment, or that looks like a good value one, and so forth. But, you know, if it's small, or if it's got something about it, you know, you've got to realize, does it have parking included? All these little things, like price per square foot compared to comparables in the local area is how you kind of really judging what the, you know, the good value is in the long term, and, you know, if it's going to compare well. And you don't need to find something which is below market. You know, just something that's fair and good price in those areas, and you know that it's a good area. That's why it should kick off. Let's go to the next slide. I just put this in there as well. We've got very detailed Excel cash flows about every cost throughout the process and everything you can be there. And I think that's very important when you just do your research. You know, if you want a copy of one of our cash flows so you can just plug in for your own properties you're looking at, by all means ask for that. But, you know, it's be hyper aware of everything in the process, all the little, extra costs, the little, land registry, all the kind of little different, there's a number of things with a tenant set up that they have to do. Is there going to be insurance on the building or a contents insurance? All these things, just be aware what they are. They're not going to be prohibitive necessarily, but there's a handful of these things which you've got to add on to your investment calculations in the beginning. And, if you're a first-time buyer, in the UK, you could be considering that with the government stamp duty and legal fees and all being told, you're probably looking at about 5% of the property value is, maybe 4.5% if you're lucky, for what you're going to have to pay on top of the property price. If you're a second buyer, you have an elevated stamp duty rate, so you might be going up to the 8% mark, and that's just what it is. I think a lot of people don't remember as well, actually, that all the costs of buying a property in the UK, it's not just lost, fees and so forth there. When you hold a property for 10 years, let's say, and you've made nice, handsome capital growth on it, when you come to sell it, that's all tax deductible, basically, in the end. So it's basically money held into the property, but, tax is a necessary evil of a successful market, and, the government makes you pay to get into it. So, it's the same for everyone. It's fair and equal, I think. So
just before you go on to that slide, Jeremy, just got a question come in from Layla. Thank you for the question, Layla. To answer your question about investor visas, is there any benefits with UK purchases for investor visas? I mean, specifically, we with IP Global, we purchase properties for investment only, which doesn't carry any additional benefits for passport or residency. However, as a group, we do have separate projects and things we can talk about on that. So it might be worthwhile having a conversation on a one-to-one basis just after to find out what it is you're looking for, because it's something that we can definitely help you on as well. I think in terms of passport residency, I think did you mention that you're doing something in Portugal? Joe?
Oh, yeah. I mean, we'll say we're not a visa company, but we like some property in Portugal, so yeah, like we do have access.
Another conversation for a different time.
Yeah, no, indeed, it's worthwhile asking. I've heard that a lot of times before, like in the UK. The UK does have a system, but it's not related to property, and it's quite expensive. So, if you get an investor visa, essentially it's going to cost you £2 million.
There's definitely options. It's popular for most people actually in the Middle East with emerging market passports, because if for passports, and if you get a developed passport, it gives you greater access from a sort of visa standpoint. Load of other benefits as well, different, again, different conversation. But Layla, of course, I can reach out to you on that and give you more information if you like.
Well, yeah, absolutely. And, from my knowledge of the market, I think Portugal is probably the safest one, and obviously a lot cheaper than the UK, probably around about €350,000. So not cheap, cheaper.
It seems to be the most popular at the moment, Portugal.
More accessible. So UK though, obviously a lot of what we said here is about picking the hotspots for where is good, and it's not to say, look, that city is good and this one is bad. That's not how the market works as such. But just to give a very a bit more of a hopefully expert opinion then on the places you probably are looking, and where we've been buying over the last 5 years. So we used to be very much just attached to London, and since probably about 2015, we started migrating to Manchester and Birmingham being kind of the second biggest property markets outside. But here I kind of just listed them in order of size of cities, actually, in the UK and what's likely happening there. So, I mean, London probably took the biggest hit in COVID and in Brexit. Prime central London, some of it took up to 25%, knock in prices, but most of it held its price, not necessarily performing brilliantly, but held its price, steadily in that time. So probably anything from like zones 3 and outwards has probably kind of actually risen a little bit, maybe up 5% or so in the last 4 years. So, not a lot, but considering all the worry and everything, it's kind of held it. So what's happening in London now, with the UK the way it is, with a bit more of a kind of economic recovery, there's much more of a resurgence. Developers have got their tails up and are building again there now, and so it's definitely in recovery mode. I don't think it's the right time to be buying prime unless you are very much a long-term safe asset kind of buyer. But for growth, I don't think that's there. But yes, potentially in the outlying regions of London, we've got to remember it's a city of 8.5 going on 9 million people, which is biggest in Europe, and Berlin being the second biggest at 3.7 million. So it's a massive city for Europe, and so it's other countries, other corporates, they've all very much heavily invested in London, and they need that machine to keep going. So London's not going anywhere, and that's still a safe market for property, but probably more the outlying zones, a bit more value. Some of this, people moving further out of the city centres to get a little bit more lifestyle there. So you can get properties. I mean, from the outlying regions, you can get properties for. We've got one on the outskirts for starting around about 200,000. But mostly anything in the centre is obviously going to be double that and a bit more. So yeah, there's opportunity, but with caution. Birmingham is certainly on a flyer at the moment. People have been investing there and it's been growing quite steadily for the last 6-7 years, I suppose. But it's the second biggest city at about 1.3 million people. It will be the first to get connected up to high speed 2. It's the railway line between London and Birmingham, projected to be finished around 2026. If that happens, I'll be amazed. But still, even if it's 2027, 2028, it's a huge, big infrastructure project, which will bring the journey times down from an hour 50 down to 45 minutes. So Birmingham becomes a commutable area for London, but equally it's a massive city and there's a lot of investment going on there. And it's, depending on who you listen to, the major consultancies, it's always either Birmingham or Manchester, which might have the best capital growth story in the next 5 years. So there's a lot of healthy stuff going on in Birmingham. Glasgow, third biggest city in the UK. Not had as much of attention as some of the others, but a very, a good high rental growth over the last year and a half. Very steady. Again, projected to have good growth. They're not building half enough, basically, so that demand is definitely there. And so you can get in Glasgow, for the size of the city and the size of the economy that is there, you get prices of Liverpool prices over there, and that's very attractive. Leeds is in the north, is very much up and coming. Biggest legal sector outside of London, big finance sector there, but 25% cheaper than Manchester still. So there's a lot of potential there. Developers have got their tails up and they are pushing boundaries in the centre of Leeds about what's acceptable, probably in my eyes, of new build prices. But there are things there which are looking good. Sheffield is very interesting. We had a project there early this year which has done very well, but again, cheaper than Leeds even, but with a dynamic economy. So good, affordable market to get into. We're talking, 130 to 200,000 pounds, from between, studios, 1 and 2 beds. So, highly affordable compared to most things around the UK. Manchester still definitely interesting. Definitely a caveat there. The inner ring road of Manchester has had a huge amount of attention in the last 5 years, and a lot of developments have come up and a lot has been sold there, and developers obviously price themselves for everything else that's been there. So when we first sold, Manchester in Chinatown in central Manchester 5-6 years ago, we were going at just under £300 a square foot. And most new build there now in the same areas is going for high 400s to £550 a square foot, which is enormous rise in value in that period of time. So as much as it's a good safe city, I wouldn't buy at that price in Manchester now. I'd be looking more at £350 a square foot to keep yourself safe. Probably then in the areas just outside the city centre, we still hold a little bit of value in them. Liverpool, steady but cautious as a sell there. Growth expectations fine. It's still affordable. Somewhere kind of in the 18% kind of in the next 5 years growth marker. So perfectly fine and doable. Probably not quite as exciting as, say, Sheffield for me, probably. And then other ones people might consider, London commuter belt towns. We had one in High Wycombe earlier this year. We've had things in the past, Slough. Not necessarily the most glamorous names, around there, but what they do offer is a lot of value and a very quick, easy access back into the city centre. So you get people happy and easy to get out of the city and easy to get back into their jobs, but a third of the price of getting into central London. So it's that's appealing on lots of levels. So So yeah, by all means, ask about other locations if you like to. That was just a kind of a general view of what I think is going to be people should be looking at. In terms of prices, what cash you'd need. Generally, most of the properties we have, some are off plan, some are completed, but you can borrow maximum 75% from a bank. I like to get people to plan for 65% lending, just to be pragmatic and not expect everything. So it can be from as little as £50,000 all in, up to obviously however much you're going for up top. So most of the time, for a £200,000 property, which could be a 1-bed in Manchester or in Birmingham, or it could be a 2-bed in Sheffield or Liverpool, you're going to need maybe £75,000 between when you first start and when property completes, all in for everything. So that's something to kind of bear in mind.
Just the question I've got, because a lot of people always get cold feet when it comes to units that aren't completed, so pre-planned property, especially if you live in the Middle East and you're familiar with developers over here not completing and not finishing and so on and so forth. But I mean, what assurances do people have in the UK working with developers that are building units that are pre-planned, just in terms of the comparison to where we currently live at the moment?
Absolutely. Look, I mean, it's got part of this is just doing the DD and making sure you're working with good people and with a developer which has got finance. Developer having finance is the biggest thing, really. So largely if you see a little red light, if you see they're asking for an off-plan property with 30% deposit, you're probably paying for the build rather than the developer kind of having a deposit and using banking finance and having their own funds to be able to do it. So mostly all our projects would be 15% down and then nothing until the end, so it might be 50% now and then another 10 or 15% when property comes to finish. We do have building warranties in the UK, so there'll be insurance there. So 10% of your deposit, it will be insured by law. You won't be able to get into that elsewhere otherwise. And and then when we underwrite and buy projects from developers, we'll insist we have things like long stop and short stop dates inserted into the contracts. And what that means effectively is that the developer can't kind of finish early and say, oh, I want my money too quickly. And neither though, which is sometimes likely as well, you might have a developer be late by, a couple of months. But, we put a clause in there which says if something goes terribly wrong and they're a year late, then you get your money back, full stop. That's the deadline, the cutoff, which means that, there's a big protection ring there. And that's important to have just in case. We've done 109 different projects in the UK now, since 2009, and we've had one in that period of time not go to completion, and very happy to be transparent about all our track record there, but equally that's something then we go into a legal case and get our clients their money back anyway. So it's important to have people who know what they're doing on your side, I suppose.
So there's one more question that's just came in regards to sort of, I think a non-British national has got no disadvantage, I believe, to sort of a British national in terms of purchasing a property in the UK. So the question is owning a property by a non-British national subject to political problems that arise every now and then?
It's not in terms of, like the country has a standard international blacklist potentially, but that might be if your passport is from countries maybe like Syria or Iraq, and actually that's not necessarily even a problem by itself. It's largely if your funds or you have wealth based in those countries, then they won't like it. But it's a very open market. For nationality wise, that's not going to be too much of an issue. It tends to be that you might have more of a limited option with lenders. If you're a British national, you might have 15 different banks who will lend to you being an expat, and you might have 7 or 8, if you're a non-British national. So, you've still got plenty of options there. It's just, but there's anymore.
Yeah, so there tends to be a misconception because obviously you can appreciate we deal with a lot of non-British passport holders in the Middle East that want to purchase in the UK for investment. So, and most of them think that they can't get finance in the UK because they haven't got a passport, British passport. So it's not the case. That obviously reduced options compared to a British passport holder, but you can still get finance. So it's just a matter of working with one of our mortgage advisors to sort of navigate the best option for you, based on whatever unit you want to purchase in the UK.
Yeah, no, I think it's, you know, like you'd be forgiven for thinking if you did some Google searching and looked for it yourself that it was very hard, because if you go to most high street banks, they might not have that capacity, but there are a number of banks there, you know, largely based on the Channel Islands, who will lend to expats, and it's a very normal everyday thing. So, you know, just ask and, you know, get introduced to the right people, and, you know, it's not too difficult. So to finish off, basically, in terms of it, I just thought I'd put, you know, with all these markets we looked at and all the research we do, you know, I just thought, you know, using a very base case example of Birmingham at the moment, you know, largely because we've just launched something there, so I had these stats to hand. But this is a prime example of, you know, why we like a market, not just, you know, a property, but why, you know, why it's so exciting and why we think the next, you know, 10, 15 years looks good. So again, when we talk about supply and demand and balance, you know, money coming into the market and movement of people. So this left graph here shows your average disposable household income between 2000 going up to 2035, and just how quickly and how much that's accelerating, and then comparing that to the orange line, which is the unemployment rate. So the differential there to people in work and people with money, it's a much wealthier city than it has been, you know, from 2020 onwards. The growth there is faster than most other markets in Europe, let alone just in the UK. And then on the population trend on the right-hand side there, we can see from the 1980s, when there was a bit of a downturn in the economy there, from 2000, it's been picking up very fast when we've seen, you know, the banking sector and just a huge amount of more regeneration and money going into the market there, and, you know, projections up to 2035 of being, you know, going somewhere near the 1.35 million people in market. So lots of people, and they all still have more wealth, and then comparing that to the supply, which we'll look at in a second. And then, so this is a map basically of the city centre, and just a number, I won't go through all these, just to give you an impression basically of all the money being spent there locally at the moment. So the red area is the traditional old school, you know, city centre, historic, I suppose you'd say, and then the kind of lighter brown area is kind of like, you know, the modern city centre there. So at the top left, in the middle is Jewellery Quarter. That's where our new project is. That effectively is the area just north of the city centre, which is largely Victorian old housing. Literally, the old Jewellery Quarter was where, you know, the UK's jewellery industry was based, and still 40% of the UK's jewellery is based there now. But, you know, lovely brickwork, old Victorian, you know, mills and factories and shops and so forth, which had largely been converted into very middle class, you know, suburban areas now. So that's probably one of the posher, if I use the English word, areas of town to live. And so there's like 200 grade 2 listed buildings in that area, and ours is one of those. And so that's a kind of, you know, it's the top end of town, but probably the most desirable area for renters to go and live in, barring maybe Edgbaston, which is about, you know, 15 minutes out of the city centre. And then just to kind of southeast of the city centre is an area called Digbeth, and that's a very different kind of story to it, but a different kind of value. So as much as that, Digbeth is maybe £380 a square foot, Jewellery Quarter is maybe £410 a square foot, but Digbeth is probably had a big boom and heyday in the 70s with factories and, you know, modern kind of buildings like that. And then, you know, again in the 80s, kind of, you know, it had a bit of a slump. So what we're seeing now a lot there is a lot of those being pulled down, a lot of regeneration going on, and so new builds coming up in that area. So, but very easily accessible to the city centre, but slightly cheaper properties. But, you know, it's what you might call like the Shoreditch area, you know, which is the trendy kind of ramp area of London. There's a lot of art scenes and stuff going on there. So it's a slightly kind of better value play. But yeah, generally what we see here is huge amounts of overall investment. Smithfield, which is next to Digbeth, that's a £500 million development, or in total be 1.5 billion. But that's just south of the central train station. So you can walk from either of these schemes to the central train station, and also with 10 minutes to Curzon Street, which is what will be the HS2 station. So, you know, in theory, you could be in these places and walk to Curzon Street and be in London and probably do a whole commute within an hour if you timed it right. So, you know, that's attractive, and you can see then why the prices look quite good. So with all this money and all this activity going on, Birmingham's housing market, the undersupply. So all, growing population. And so, from 2010 back here, leading up to 2020, they've only been able to develop, just under 25,000 units in this time. But they're about 40%, 48% of the needed stock that's been built. And with the rising population, they keep getting hammered the problem more and more and more. So, for us as investors, it's music to our ears. Like they cannot find the areas and they cannot build to get the units for that population there, which is just puts so much pressure on market prices to go up. So, the basic expectation is about 20% over the next 4 years, or 19.5% in terms of average capital growth. Our job is then to find those areas which might slightly outperform that, in market, because they're well priced. So, this is what we look for stat wise in terms of a market, what's going on, and and then trying to find good price per square foot compared to its competitors. And that's how it works. And then just to kind of rub it in a little bit, this is the picture of our latest project. So you can see very much this will be attractive for local renters. It's a red brick, grade 2 listed historical old jewelry factory, which has been made into prime, residential properties, walkable to the city centre. So that's the kind of thing we're happy and looking for. So plenty of talk. We have had a fair few questions in throughout, but by all means, feel free to ask anything now if you've got anything more to hand.
We did get some questions in before the call, so we'll go through them quickly. But if there's any questions that anyone's got, feel free to type in the box below if you've got any questions at all. I suppose the same level of research that we've just gone through briefly there with the Birmingham development is the same sort of information that you can get from any area that you're interested in, essentially. If we've got a place there that's available for investment, all of the information in regards to development, the area, reasons why, every location's got its own story for investment. So we could send as much information as possible to you on any specific area in the UK or Europe. And most importantly, the cost sheets that go with that, because it's important for us to sort of make sure that you understand exactly where the costs go and how they compare to assumed growth rates for your investment. So one of the questions that came through, I think we answered it briefly earlier on in the call, is there we go. So is there a way we can avoid stamp duty?
Nice
If
try.
so, let me know. I'm also interested in that as well.
Yeah, right. Well, look, I mean, we all hate tax, especially when we live in the UAE, don't we? We're in the region. Not really. No, you can't. I mean, whether you're buying in a company structure or whether you're, buying as an individual, you can't avoid, stamp duty tax. Basically, if it's your first property globally, you should pay the kind of the lower rates. If you owned or have owned any property in the world before, then you should pay the kind of second homeowner or investor rates, which basically adds 3% of the property price on for government stamp duty. So, I mean, I'm sure there's people can try and hide things on their statements and so forth, but I think the world's getting a slightly better connected place with that tax environment. So I would say just do the right thing. And as I said before, when you come to sell the property, everything, including legal fees, the stamp duty, anything set up, anything basically it costs to set this business up, you can negate off capital gains when you come to sell it in future. Yeah. Every developed market have some kind of capital gains tax, and so everything you spend takes off that, and hopefully will reduce anything from your effort.
Awesome. Just had one question come in again. What are your thoughts on buy-to-let on Airbnb? So have you come across that before recently in terms of people looking at Airbnb for investment?
A lot of banks will have, it's not necessarily, you're not stopped on it. It's just that it's not a bad model to go. It's just a lot hard to get finance for it. A lot of banks are much less interested. They like to see something very assured. They know a market rate should be this of rent. You're going to have a long-term tenant. So it's a lot more difficult to find finance for it. So, it tends to be, you get people who are buying more in cash and then kind of going to Airbnb because you get potentially, maybe it could be higher risk, but sort of potentially a higher yield by having multiple people coming in and staying in the property.
Yeah, okay. So another question is, do you see mortgage rates going up over the next year or so? Obviously, with the Bank of England rate potentially going up from 0.1, I think, to 0.25. I think at some point the mortgage rates would follow suit normally. Do you see that being the case, and what rates typically would you sort of see if that is the case?
Well, yeah, it's kind of a yes and no. Like, it doesn't always track, as much as a lot of banks have their rates are based off the base rate of the Bank of England. Doesn't always mean that that's, their new offers are suddenly just going up. It's a very competitive market, lots of people buying, and there's a lot of business out there for the bank. So, it's likely they're going to be a bit of a scramble to be competitive. And in the last 6 months, the rates have been coming down again, even more. I mean, I was speaking to a couple of banks last night, and there was a couple dropping below 2%. Now, I'm not saying that's your regular kind of every day, everyone can get it, but the fact that it exists in market in certain circumstances, that's very positive. I would tend to say that most of my clients end up getting kind of, it might hover from 3 to 4, and if you're in a slightly difficult situation, as in you might be based in Saudi, have less options, it might be that it's 4.5% or something like that. So like in those scenarios, what I tend to tell people to do is take a 2-year fixed rate, at a 4.5% rate, and when the property is then completed, you can remortgage, and banks tend to like properties might get a slightly lower rate, if the property's been on market for a couple of years. So it's there's ways around it, and you just need good advice for that kind of thing. But generally, even if rates do go up in the near future, you've just got to bear in mind where we're coming from. We've just been at 0.1%, which is literally a historical low. Back in the 80s, we were having like 13, 15, 18% interest rates, and so they've just been on a sliding scale going down ever since then, basically. And so we it can afford to go up a little bit, and we can afford to still make very good investments for a good decade yet with interest rates the way they are.
Okay, awesome. Unless anyone else has got any other questions, I think that's it for the questions. I think one more just came through there. So yeah, I can answer that one. Is buying a property in Portugal, can you get an investor or golden visa? So absolutely, it's proven most popular for people in the Middle East to get a second citizenship or residency, just a second option, passport. Number of reasons: geopolitical, tax benefits, education for families, and increased travel and visa. So with Portugal, I think it's like 140 places you can travel without having to get a visa. So for certain people, it's actually really good to have that second option for passport or residency. So that's definitely something we can provide you more information about if that's what you need. Yeah, that's probably the most popular place to get residency or citizenship, because it's the most easiest and to sort of obtain, and the most cost effective compared to other ones that are out there.
It's worthwhile bearing in mind, I'm aware as well, that the government in Portugal are changing their rules as of January 1st. So it's going to get a little bit more expensive to get, well, not just more expensive, as in like they're going to limit the areas you can buy into it. So Lisbon and Porto will be excluded, the big city centres, which have risen in price quite a lot, partly due to this. And if you're buying via fund, that's going to go up as of January 1st. So there's a little window there of it being cheaper still, if you need to kind of go for it. But yeah, by all means ask. And equally, if you want to look at completely different markets altogether, I would say a lot of good things about Germany with their tax advantages and things like that. So by all means, get in touch with that if you like. But yeah, thank you for holding on with us for just over an hour. So
no, thank you for that. So Kareem, yes, I can get some more information to you on that, no problem. I'll have your details, so I'll get in contact with you and give you more information on that. So, thank you very much for joining the webinar session. Hopefully you found it useful. Just to sort of close off, again, me and Jeremy have been working together for a number of years. And, if it's a case that you're now looking to purchase your first property in the UK or Europe, and you just need help and guidance of how to do that and the steps associated with that, more than happy to help. If it's a case that you're looking to add to your property portfolio, of course, that's something we can help with as well. So yeah, feel free to get in touch. If there's any questions, let us know. Hopefully you'll have our details sent out to you after this anyway. And thank you very much. Enjoy the rest of your evening.
Thanks very much, guys. Good night.